Let's do it.
Hello, everyone. Welcome, welcome. Happy Thursday. We are so excited to have this call with you today. If you joined our last call with Talia a couple of weeks ago, or you watched it on the replay, please drop a one in the chat. And if this is your first time meeting Talia, please drop a two in the chat just so we can get a gauge. I think you are going to get lots of value out of today's session. I know the last one was a big deep dive and Talia never fails to disappoint. So I know that this this
It
one
was a
is
big
our
deep
first.
dive into the brains, into your
It
brain.
was, it
Yes.
was, and it was fantastic. I know the feedback we had last time was amazing. So yes, please do just let us know in the chat. One, if you have either seen the call or you were here live on the call last time, or two, if this is a new call for you as well. And I know that we will be having some more people join us. And what I'm going to do is I'm also going to drop the Slido link. Very amazing, Chrissy. Two. Okay, so you're new to this call as well. Amazing. I will let Talia introduce herself a little bit more, but you're going to get to know her very quickly. Rijo, okay, great. So we've got some new people joining this call. I highly recommend going back and watching the call from 2 weeks ago after you've seen this call as well today. So I'm just dropping the Slido in the chat here. So at the end, we will come to your questions. So please feel free to ask your questions as we go along, and then Talia will address them at the end. But that's everything from me. Talia, thank you so much for being here. We're so
Thank
excited to
you.
have you.
Oh my God, I had so much fun last time. You're incredible people. So thank you for having me. I love this. For those of you who don't know me, and I see a lot of twos, my name is Talia. I am a financial analyst. So I have the CFA designation. I am a chartered financial analyst. So I know the numbers, I know the traditional finance side of things, but my true passion and my love and what I've spent the last decade of my life studying is a field called behavioral finance and economics, actually. If any of you have heard of behavioral finance, essentially, traditional finance says that we are rational people and we should do things. We optimize costs and supply and demand and all that good stuff. And behavioral finance says, yes, but not really. That's essentially what we're going to be talking about. So, last time we were together, we talked about the internal systems, the things, that's why I said, like, we went into the head last time, that shape how we experience money. We talked about all kinds of things. We talked about the stories, we talked about the emotions, our identities, all of the invisible things that run in the background. And if you were here for that, you learned that, money isn't just math. It's the perspective through which we see ourselves as creators of wealth. And that's really important. I often say that what separates people from, financial success versus not so much financial success is just your ability in yourself, or your belief in yourself, in your ability to create it. So yeah, today I basically want to zoom out a little bit. And, this isn't so much about the internal experience of money, but it's about the structures that shape our financial outcomes. Because here's what behavioral finance teaches us, like I said, over traditional finance. Um, and that's that you can still understand the psychology perfectly and still struggle financially if your systems are poorly designed. So again, like I said, traditional economics assumes we're rational. Behavioral economics came along and said not quite. So basically, it studies why we procrastinate on investing, why when we lose, it feels so much worse than when we win, why we panic when the market is volatile, why we're checking our portfolios like there's some sort of Instagram notifications. So understand that these are all patterned behaviors. And if behavior is patterned, then outcomes aren't about discipline, they are about design. So today we're talking about that design. And just so you know, there's no budgeting hacks today. There's no, motivation. We're talking about how to build financial structures that work when you are tired, when you are distracted, when life's, when you're emotional. So, honestly, I want you to feel like wealth is inevitable, and that's what we're going to talk about today. So let's look at the table of contents. Molly, let's go. So today we're just going to learn about, again, why this idea of motivation fails us, how to see wealth as infrastructure. I love, if any of you know Adam Grant, he has an amazing book. His last one is called, oh my God, oh my God, oh my God. He wrote, think again, all these, anyways, it escapes me right now, but he talks about the idea of scaffolding. We have to build scaffolding, hidden potential is the name of the book, around us to make finance and financial success inevitable. We're going to talk about, the human brain. and how it doesn't work in congruence with the way the financial system is built. And then we're going to talk about what I mean by this word sophistication. It's an economic term. And we're going to become sophisticated investors and wealth builders. So, like I said, we're off to the races. Let's do it. Why motivation fails. Okay, so let's just, oh, no, back one more, Molly. Stay here for a little bit. I love the idea, or we love the idea that if we just cared more or tried a little bit harder, then our financial lives would fall into place. But motivation is emotional. Motivation fluctuates. It depends on a lot of things. It depends on our energy. It depends on how your morning went. And building wealth on something that's unstable, like motivation, is just not sustainable. It's like building a house on sand. So, before we talk about systems, we need to understand that relying on motivation guarantees poor results. It's just the way it is. Next slide, Molly, please. Here it is, the discipline myth. So discipline requires us to be in a consistent future orientation, okay? We're thinking about future us, but the problem is we as humans don't think that way. We systematically overweight now relative to later. And that's why we always hear things like, what do you hear? You can put it in the chat. I'll start next month. I'll invest when I have more. And this is what we call in economics cognitive discounting. We're discounting the future relative today, which basically means we don't like it all that much. Now, discipline also requires emotional stability. It assumes that we're going to stay calm when markets drop, but no matter how long we've been doing this, when you see your portfolio down 30%, that's hard, right? And even if you know the long-term plan, even if you know the market always recovers, and it does, it's based on earnings and inflation. Those things will never go away. Even though your nervous system, when it sees it drop, it doesn't want to cooperate with the long-term plan. And then lastly, discipline requires repeated active effort. Now think about that. It assumes that you're going to keep choosing the hard thing over and over again, but we don't, right? Kind of like dieting. We want to conserve brain power and naturally default to what's easier. So if discipline keeps failing you, could it be, and I just want to plant this idea, could it be that it's because we're fighting forces that we're not thinking about? And that's the forces that we're going to talk about today. Next slide, please, Molly. Predictably irrational. I love this. Okay. So economics operates on the assumption that we are, like I said, rational humans. We call it the Eco 101 model, everything that you learned in first year university economics. It talks about the fact that we look at probabilities when we make choices. It talks about the fact that we are always optimizing for our well-being and that we're making decisions in our own self-interested or in our own self-interest, basically. And then behavioral economics came along and said, that's adorable. Not really. This isn't how people work. We procrastinate predictably. We overreact to losses. We categorize money mentally, and we'll talk about that later. We choose defaults more than we like to admit. You've got to think about where these defaults are in your life. There's hundreds of these behaviors, and we're going to talk about a few of them. Dan Ariely, whose book I put on this slide, he popularized this idea, and he said that we are predictably irrational. And that's the entire premise of what we're going to talk about today. Next slide, please. Okay, so this is one of the heaviest slides of the presentation, so I want to have some fun with it. And I want you to think about where each of these elements shows up in your life, and we're going to talk about them a little bit. So present bias, let's start there. So this is one of the most we call robust findings in behavioral economics. All that means is that it always happens. No matter who you are, no matter where you are, we all have present bias. And this is the tendency to, like we say, disproportionately value immediate rewards over future ones. So one of the most classic experiments, people were asked, and think about this, what would you do? Would you prefer $100 today or $110 tomorrow? Put it in. Ciao. Most people say $100, okay? But then if you were to ask the same people, would you prefer $100? Oh, okay, right there. 100. Okay, well, that's because you got, really? 110? Okay, most people say $100 today versus 110 tomorrow. This is called hyperbolic discounting. But if you took that same question and said, would you rather $100 a week from now or $110 a week and a day from now, people usually choose 110. And this doesn't make sense, okay? And this is what we call in economics time inconsistency. And where do we see this? Again, the I'll invest later paradox, okay? Or not paradox, just phrase. I'll increase retirement contributions next quarter. You do this even though you understand how compounding works. You know the market always goes up and you want to be on that growth curve. And that's because the present version of you always wants to override the planner. All right, that's again present bias. We see it all the time. Loss aversion. This is another big one. Um, this is a big part of the research of Kahneman and Tversky, who won the Nobel Prize in economics. We mentioned Dan Kahneman last time, his book Thinking Fast and Slow. And what they basically showed was that losses hurt about twice as much as equivalent gains feel good. So let's think about that. What does this mean? If I were to give you $100, it feels great, right? Like, okay, not bad. Thanks. Thanks for the $100. But if I took $100 from you, oh, you're going to be talking about it for a while. It feels horrific. Now, let's translate that into the markets. So a 10% drop feels catastrophic, whereas a 10% gain is like, oh, great. That's nice. And again, this is why people panic sell. So the same people that understand long-term investing, but they do this because losses activate something visceral. And that's that financial losses feel like a threat, right? That's why people don't participate in the markets. They're afraid of losing. So let's again look back to our discipline friend earlier. All the discipline in the world collapses under this threat. I have been doing this for 20, well, maybe not 20, 15 years. I had, well, we'll talk about it later, but I had a little bit of money on Nvidia before the earnings yesterday night. And yeah, it tanked this morning. And I still feel it, right? Again, I know how this works. Now, the next one of my favorites, this is called narrow bracketing. So, if any of you have read Simon Sinek's Infinite Game, I think he talks about this quite a bit. This is one of my favorites. And what this means is that narrow bracketing causes us to look at decisions in isolation instead of part of a larger decision set or portfolio. So broad bracketing, basically, you take in the big picture. Broad bracketing is better. Narrow bracketing is easier. So that's why we tend to do it. So let's look at this in everyday life, right? So what this looks like is, one day, let's just say you make a bad investing decision. And then you decide that the markets aren't for you. So you've made this huge decision based on just one moment in time. People tend to view wealth daily. This is the thing, instead of over years, even though we know this is a long game, right? And then if you think about this concept outside of finance, let's say I were to ask you what you feel like for dinner. So let's just say, economically speaking, your favorite meal is pizza. You're always going to choose pizza because that's what you love most. So traditional economics would say you would choose pizza because it's your favorite. Narrow bracketing. What's my very favorite thing today? I'm going to choose pizza. Broad bracketing is, you know what? I value some variety this week. So I had pizza yesterday. Let's choose tacos today. Okay, so that's narrow bracketing versus broad bracketing. Okay, inertia. Inertia and status quo bias. This is very, very, very important for us to understand. And it's one of the most famous findings in behavioral economics. And they use this retirement savings plan study. When employees have to choose to opt in to a retirement savings plan, participation was super low, right? People didn't want to deal with it. But when it became the default, so when you joined the company and they automatically enrolled you without asking, and you had to make the conscious choice to choose to opt out, what did they find? Participation skyrocketed. So, same humans, nothing changed, same salaries, same incentives, but all they were given was a different default. So this is very important. And why does this matter? Because as humans, we stick to what's easiest, especially if those decisions are uncomfortable or complicated, which is why so many people don't have wills or proper insurance because it's easier not to do anything and they just don't want to think about it. It's too much. So when saving and investing, if we make that the default option, that's when it becomes consistent. That's when we are able to actually do it. So just to reiterate, we prefer today over tomorrow. We hate feeling like we've had something taken from us, okay? We tend to make decisions in isolation instead of considering the full picture. And if something requires energy, the natural tendency is to avoid it. And again, I'm just bringing up a few of these. There are so many. There's literally hundreds of them. So you can start to see how behavioral tendencies, right, are working against us when it comes to building wealth for our families. And then to make matters worse, we think it's our fault, which it's not. Next slide, please, Molly. Okay, I love this. Wealth failure is not a moral failure. I'm always very conscious of telling everybody, let's take shame off the table. Just because we fail, we think that there's something wrong with us. I'll always tell my investing community, I say, ladies and gentlemen, you don't learn from your wins. You'll learn from your losses, right? So just this idea that wealth is in fact a design failure, we are working with a design problem. We are trying to operate inside of systems, okay, the financial system, that doesn't account for how our brains work, which brings us to, next slide, please. Wealth is infrastructure. Okay. So if wealth failure, like I said, is a design failure, then the obvious next question is what? What should we be designing? And that's where this concept that I love so much, and it's called choice architecture. That's where this comes in. So choice architecture is the idea that the way our decisions and our options to make decisions are structured. So basically, the defaults that we mentioned earlier, it could be that. It could be the order options are presented. It could be the friction of getting out a high cost mutual fund. It's funny. I spoke to someone the other day and they're just like, "Oh my God, how do I get out of this high cost mutual fund?" They make it so that you have to call the banker, you've got to call the bank, you've got to speak to 7 people, then you've got to deal with the trauma of them telling you that you don't know what you're doing. Like again, it's really hard to get out of it. That's called sludge, actually. But again, away from that, that's essentially, what we're going to be talking about. And I want us to think, or not, I want us to think, we think that we make financial decisions deliberately, but we don't. Know that the environment is always guiding us. You know how I just mentioned sludge? That gentle guiding of the environment is called a nudge. Richard Thaler wrote the book called Nudge. So we're always being influenced. Okay, this could have, we see this everywhere. Just a quick example of that. Think of when you go to a restaurant and you see menu options. So two things on a menu option. You notice now you don't see like .00 in terms of pricing. You see 18, 17, 12, 5. There have been many studies done to prove that people actually believe and it feels like you're spending less if you don't see the .00 because you see less digits. Okay. Another thing that they use is called the decoy effect. This is one of my favorite, where you'll see like a $600 bottle of wine and then you see that the restaurant actually has no intention of having you buy that, but it makes the $400 bottle of wine seem cheaper. Again, all of these things, these are called nudges, are moving you to try to create decisions that they're trying to influence you on so that they make more money. Always happening. All right. So I want you to ask what environment you're operating in, and then is it designed to support the behavior I want? All right. Next slide, please. Okay, so let's talk about defaults. This one is super important. When we build financial systems, we want to think of these 3 design choices that matter. And the ones I put here in terms of the default effect, we want to first realize there's opt-in versus opt-out, what I spoke about with the retirement accounts. So if people have to actively choose to participate, participation is low. If they are automatically enrolled and must opt out, participation skyrockets. One example I just want to show you is it's a famous organ donation study. And they found out the countries that automatically enroll you into organ donation have close to 100% uptake in organ donors. Whereas countries that have you have to actually opt in and it's not like a default, they have about 12%. So a huge difference. Remember, we talked earlier when decisions are difficult, nobody wants to think of, dying, right? They tend to not do them. So that's when these opt-in versus opt-out become very, very important. And people can really sort of, influence a decision that you're going to make. And unfortunately, often they try to influence it in their best interest, not so much yours. The other part of this default effect I want you to think about is something manual or is it automatic? So if savings or investing requires you to do something repeatedly over and over again, they found that eventually, again, diets are the same. Eventually, it decays to 0. And at some point, we fall off the wagon and it's hard to get back up. And, what we want is to have saving running automatically in the background. And if it is running in the background, it tends to continue, right? Because we don't realize it. We don't have to think consciously about it. And then this third issue of the default effect, or the third tenet of the default effect, attention required versus passive. So again, anytime we're within a system that requires energy from us, so willpower, attention, anything like that, it will fail because we can't rely on willpower alone. The more it runs without intervention, the more we don't have to think about it consciously, the more it succeeds. So now let's just talk about two studies that prove this concept, and they're financial studies. And again, we're showing you this because I want you to see how it applies in your real life. Next slide, please. All right, so these are two very, very famous studies. The first one is called Save More Tomorrow. And, here employees committed, this is important, in advance to increase their retirement contributions every time they got a raise. Okay, so what happened in the study? 80% of employees that were offered the program joined. All of them stayed in the program. And what did the average savings rate change from to? It was about 3.5%. And after this program was introduced, it was 13.6% over 40 months. Huge. Now, again, remember, nothing about their income changed, nothing about their intelligence changed. What's changed? The design. Okay. This is choice architecture. So remember what we spoke about, right? Increasing savings when people got raises counteracts what? It counteracts loss aversion because the take-home pay doesn't actually go down. Why we don't do it before a pay raise, it's like we see that, whatever, a couple thousand, 2,000 a month, and then suddenly we see less. That hurts. Loss aversion, right? This way, if you time it with a raise, we don't feel that loss. And then there's inertia, right? But this is inertia in the right direction. So remember, opt in, opt out. In this case, they have to opt out. They made the decision before they got the raise. And then they had to consciously opt out. What does that require? Effort. So they just leave it, right? And this is in their best interest. So basically, what they did in this study, they turned behavioral biases into an advantage instead of a liability. And just to note, you'll see Richard Thaler's name. I said he wrote Nudge. He won the Nobel Prize in economics for behavioral economics not that long ago. I think it was like 12 years ago. The second one, very, very interesting. Odysseus to the mass. So this one researched a savings product that restricted withdrawals until a goal was achieved. So this one was voluntary. And what it did was it limited flexibility in you being able to take out your money. So again, it was, like I said, volunteer. And uptake they found was significant, especially, and this is important, among people who self-identified as having self-control problems. Why? Because people know present bias, right? The wanting today more than tomorrow. They know that this undermines them and they want guardrails. Remember? Scaffolding systems, right? So again, not a discipline story, a design story. So what do we learn from this? If we want better outcomes, what kind of systems do we need to make? We need systems that default us into the right behavior. They make saving and investing automatic, not valuable. They reduce the need for our attention because the brains are lazy, right? We want to just kind of do what's easiest. We want to align increases with income growth. This is kind of my favorite. It's like a little extra, little bonus that they put in there. And we want making opting out possible, but the opt-in is the default, right? So that we don't really need to think about it. And that's the difference between relying on discipline and then building an infrastructure. And again, we're thinking about what infrastructure are we going to build? All right, next slide, Molly, please. Okay, so sophistication around designing around your future self. So we talked about earlier this idea that humans are time inconsistent, again, valuing the present disproportionately better than the future. But there are two different types of time inconsistent people, and this is important. Naive, they're called naifs, and then there's sophisticated people called sophisticates. So the difference is naive people believe that their future self will be better. They say things like, I'll start next month. I'll invest when I have more money. But next month, as we all know, never comes. And then when it does come today, nothing changes. Sophisticated people, on the other hand, sophisticates, they understand that something is uncomfortable and they know that their future self is going to feel like they do right now. And so they don't rely on motivation. They build systems. And the purpose of this talk is to move you from the naive to the sophisticated. Basically, it's just to help you design a financial life around the fact that you're human. And when you understand that, you're then armed to do so. Next slide, please, Molly. Okay, so that's what we're going to do. And we're going to talk about what this looks like in practice. And let's go to the next slide. So I tried to make this simple. We only had 45 minutes. So again, I say this, that I am oversimplifying this. And if anyone wants to go deeper, feel free to email me. But I tried to really, for the purposes of our talk today, think about 3 design principles that you can build into your own infrastructure. So let's talk about these. The first one, reduce decisions, right? We talked about the status quo bias. So every financial decision, know this, it drains mental energy. The more choices you have to make, so let's think, what are the choices that we need to make? We need to choose when to invest. We need to choose how much to invest. We need to choose when to rebalance. There's all kinds of decisions that have to go on behind the scenes. And the more decisions there are, called choice overload, the more likely we are to avoid them completely. This is why people don't enter the markets, okay? They think they're going to make a mistake. The second thing is removing friction from good behavior. Basically, make good things easy for yourself. So if investing requires, logging in, finding your password, transferring money, thinking about it all the time, obsessing, you're not going to do it. I want you to make good behavior automatic. And then the third one is add friction to self-sabotage. All this means make bad things hard. Okay. Things that you don't want to do, make them hard to do. I've heard of people who actually take their credit cards and freeze them. Like they put it in a block of ice and stick it in the freezer. That would be adding friction to self-sabotage. So yeah, we don't want, it to be so easy to just buy something. Okay, I'll tap my phone. We don't feel the pain of paying. In that book, Predictably Irrational, that we put at the beginning by Dan Ariely, he has another book, I think it's called Money and Sense. It's this idea that what's happened is that we've lost what's called the pain of paying. Things are so easy right now. We have ads coming at us. I saw something recently on TV too. I was watching and there was a commercial and there was literally a QR code on the commercial to buy that thing. That's how easy it's gotten. And that's why we've become broke, not because we've lost self-discipline or we need financial literacy. The systems are broken. Our systems are broken. Okay. Sorry, I just went off on a tangent there. So now everybody, we have these design principles. So they are, again, reduce decision, make good things easy, and make bad things hard. And let's apply them to 3 areas of wealth building, which is making money. Okay. So this idea of capturing what we earn, protecting our money, and then growing our money. So let's talk about capture. Molly, next one, please. What I mean by capture. Okay, making it basically. So the most dangerous assumption in personal finance is that people will do tomorrow what they intend to do today, because they won't. We know this. Again, I've been studying this for 15 years. I don't do this. So when we talk about capture, we're really talking about how do we intercept money before our brains get involved. Automatic saving doesn't work because it does. It doesn't work because it's sophisticated. It works because it's boring. Okay, that's the key. And boring is powerful. When contributions happen automatically, that money never becomes part of our mental spending account. So it never feels like a loss, right? We've earmarked that money for investing. It goes straight off our paycheck. We don't see it. That's what it's for. It's for the investment account. It's not to pay off the credit card bills or to go for an expensive dinner, right? So, let's talk about that actually. We haven't mentioned that. Mental accounting. So this idea that if you never see it, you don't spend it, it's just another tenet of behavioral finance that basically says we subconsciously account for money depending on how it was earned or what it's meant for. So let's think about this in the context of Las Vegas. I love this. They call Las Vegas the behavioral finance playground. What do you see above the craps tables on the next level or beside? Gucci, Prada, right? Why? Because when you earn something that you don't believe when you win something that you don't believe you've earned, it goes into a separate mental account. And that's like, get rid of it, buy something, treat myself. It feels different than money that you would just earn from a job, right? Again, Vegas knows this, but we can use mental accounting to create structures that actually work for us, not against us. The other thing, when we on capture inertia. So once it's set, you leave it alone. So again, once you set something, don't touch it, leave it. And then loss aversion, we're also talking about that like I said, you can't miss what never hit your spending account. So you're hitting all of these different behavioral finance tenets just by doing these automatic things. So again, going back to the status quo bias that we talked about earlier, we don't want to have to make too many decisions because our brains are lazy. So you want spending to require a decision, a conscious one that might be difficult. You'll often hear people saying, wait 3 days. If you still want it in 3 days, buy it. Okay. Again, that's an idea of friction. That's how people add friction to the things they don't want to do. That should have friction. Saving shouldn't. That should be easy. That should be the default or the status quo. So again, if we design systems properly, wealth accumulation stops being this act of discipline that we have to white knuckle, and instead it just becomes the byproduct of a payroll, right? I'm just someone who automatically invests 10% because that's just what I've always done. It's who I am, and I don't do otherwise. That's what we want. Next one, protect. So this one is a little different. It's not protection in the sense that you might think that I'm talking about protection. It's not about protecting against market crashes or, risk mitigation or anything like that. Here, protection is protecting yourself from emotional decisions that you might make in moments of uncertainty. And, the most important investment decisions should be made when you're calm and not when Trump has sent the markets into a tailspin, right? That's the key here. So, a pre-committed asset allocation or something like an asset allocation ETF, or those of you joining us from the States, I know target date funds are super popular. Everything essentially in all of these instruments is taken care of for you. All you have to do on the front end is decide your risk level. And then once you've done that, it just runs in the background. It literally runs for the rest of your life. A target date fund, you say, I'm 30 now, I want to retire in 40 years. And that's it. You buy the fund and it's always rejigging things behind the scenes as you get older. Make it super easy. True emergency funds, or, what did I write here? Emergency funds accessible. Yeah. I call them opportunities funds, by the way. Don't call them emergency funds. I think they should be frictionless, yes, because it should be accessible. But again, there's a bit of an identity question here that I want you to think. Are you someone who guards this life for life or death emergencies? So, this isn't your pay your credit card fund. If that is a pay your credit card fund, don't make it so easily to access. This is a family member needs a life-saving surgery account, and you really need to, what's the word? Take that on as an identity. I am not someone who just spends out of the, emergency account. And in terms of your long-term portfolio, yeah, you do want a little bit of friction here. So studies show that the more often you check your portfolio, the more losses you actually experience, both psychologically and actually. Because like we said, loss aversion makes short-term declines feel really crappy. They feel catastrophic for us. And then we do stuff. We think that we're smarter than the markets. And then we get in there and we try to change things up. We sell, we trade, we buy things that we shouldn't, and we don't want to be doing this. So fewer portfolio checks are actually better. There was a joke that when the tariff announcement was announced and markets, tanked, I think in 2 days, 30% or something, they said the people that did the best are the ones who worked that day, because they didn't actually see it and they didn't get a chance to go in and like change things up and panic sell, right? So, again, I say this, assuming, of course, that you've got a portfolio of broad market ETFs, that you're invested in the market and not some sort of crazy speculative stocks, which, yeah, you might need to monitor. But again, we don't typically recommend that. So we can talk about that later. Okay, grow. Next one. So growth is where our sophistication, like I said, I'm trying to teach you how to be a sophisticated investor. This is where it really shows up because why? Growth requires patience. And what kind of world do we live in? What does our world reward? Not patience, reaction, acting quickly, right? The market does not reward activity ever. What does it reward? Endurance. We are playing the long game. Remember, I always say boring, unsexy decisions performed over decades. That's how we build wealth. And then, how do we add friction here? Well, the best way to add friction is, we talked about this idea of windfalls and bonuses and sudden increases of income. Give yourself rules around how these are spent or invested, because without those rules, those events tend to expand your lifestyle. I know on the last call, one of our questions was, how do you avoid lifestyle creep? Well, again, we're building a system to avoid lifestyle creep. Remember, always think of that save now, tomorrow study. When you get a raise, instead bump up your investment percentage. Okay, again, that's a system that works for you, not against you. Whereas lifestyle creep, because of mental accounting, you earn more. What do? We want to improve our lifestyle, so we buy the thing. That doesn't help you in the long run. Okay, next slide, Molly, please. The sophisticated wealth builder. So keeping the last three systems in mind, what did we talk about? We talked about capture, we talked about protect, and we talked about grow. Remember, as sophisticated investors, we don't assume that we're disciplined. We assume, we don't assume that we have all the information. What do we assume? We assume that we're imperfect, flawed human beings. So again, let's just think about that. So from capture, like I said, we don't rely on motivation. to invest. We don't even rely on motivation to earn. We intercept our desire to spend it. We build systems, and then if you think from the earning perspective, I saw a question about earning. You can build systems around earning too. What are some of those? We can ask for raises. We can raise our prices. We understand that our brains see different buckets, like I said, these mental accounts, and we build accordingly. Actually, here in Canada, I think we have some Canadians here. There's an investment platform called Wealth Simple. I love it. I use it. And something that they do, which I love, is that you can open multiple checking accounts within sort of your checking account, and then you can rename the account and put a little emoji next to the name. So, for example, you've got like vacation fund with a little umbrella, beach umbrella, opportunity fund to have with little stars. And this is mental accounting in action. It seems like frivolous, but again, it's this idea that your money has a job to do and your brains want to do it. The brains don't like open loops. So something so simple, like I'll often say, people will say, I don't know why I can't save. And I'll be like, okay, what do your investment accounts look like? And then people say, I don't have them. Well, if millions were circling above your head looking for a place to land, if you don't have the accounts to hold them, the money is not going to land. So, by virtue of you opening an opportunities fund or a vacation fund, your brain in the background believes I need to fund this account because I opened it. Again, the brains don't like open loops. So, again, for protection, we talked about commitment products. So, those forced savings products, target date funds, asset allocation ETFs. Think you want everything to be done for you, and all you have to do is send money there. And then you go and live your life. And then we talked about grow. So grow was all about understanding that we're playing the long game and adding rules for bonuses so that lifestyle creep doesn't happen. So we are engineering. Remember, we want to make good financial decisions the default. Next slide, please. I'll be disciplined later. Okay. So I just really, really want to drive this point home. Who are we? Are we the I'll start saving next month? The I'll invest when I make more, the I'll raise my rates when I'm ready, people, or are we designers? I want us to design now for the future version of us. And that future version of us, we know because life is life. That future version of us will be tired. Or that future of us, I always like to say, she avoids hard things and wants to watch 5 episodes of Law and Order in a row. That's the future version of me anyways. That's what I tend to do. So that's sophistication, not the watching Law and Order, but understanding that you want to design a system that is foolproof in those moments where you just don't have the wherewithal to do the right thing. I think it was James Clear, I'm not sure, who said, we don't rise to the level of our intentions, we fall to the level of our systems. So again, I always want you to think that. Next slide, please, Molly. Okay, this is an interesting slide. I want us to sort of think about this. From the perspective of you as an individual investor, you absolutely need to engineer your systems. Again, everything that we've talked about today. But there's another perspective here, and that's that behavioral finance does also study the psychology of the markets and how the markets adapt to human emotion. And that will be the subject of our next talk, I hope. One of my, you're a nerd when you say my favorite economist. My favorite economist, his name is Robert Shiller. He also won the Nobel Prize in behavioral economics. And, what was I talking about? The market. Robert Shiller. I just lost my train of thought. I don't know. It doesn't really matter. But anyways, it's that. Oh, sorry. His last book called Narrative Economics. So that's why I wanted to talk about him. He talks about how, bubbles are formed and how the markets essentially, work around human psychology. And, a term that we haven't mentioned yet, and I think it's important, is called salience. And what salience is that we make decisions based on information that's vivid or easy to recall. So right now, what's salient? NVIDIA's explosive gains, woohoo, Bitcoin billionaires, Instagram, this is my favorite. Oh my God, I hate it so much. Instagram posts of people saying things like, I was $40,000 in debt, and now I have $10 million. We see that and think it's true because it's shocking. They are not true. It is impossible to suddenly, after 3 years, have $10 million without taking an extraordinary amount of risk. So if you take that kind of risk and you've made $10 million, like that's a lottery. You know what I mean? There is a much bigger chance that what you did was very inappropriate and you would have lost everything. Okay. But again, we do things because it's visible. And this is what dominates our thinking. We rush in, demand pushes prices up. So, oh, what I wanted to talk about. Sorry. This idea of right skewed markets, I just kind of want to show you how markets determine or are built around human psychology just as much as our human psychology is built around everything that's affecting us. So what do we hear about? Like I said, Nvidia, Tesla. So we think that these right skewed growth stocks are where we need to be. So what do we do as the market? We put all of our money there. And what does that do? That brings prices up. And then what? Once prices are up, they're no longer a deal, they're expensive. So again, we fail, right? And then we think we can't do this. The market sucks. I hate this. The other part is if any of you have heard of something called the equity risk premium. What the equity risk premium is that people have to be incentivized to participate in the markets, which are inherently risky. So bonds, for example, give you 2 or 3% a year. Super safe. If the government of Canada or the government of, the US government defaults, we've got bigger problems than our bonds. So it's pretty safe. So to compensate people for putting their money in the market, they have to be compensated by a 9 or 10% return, which is historically what the markets give. But why does that happen? Because we remember the market crash. We remember what it felt like if we lived through 08, 09, okay? And then we pull our money out. So we say, I'm not going to go in unless I'm given this significant equity risk premium. So again, that's where the equity risk premium comes out, having to compensate investors for participating in risky markets, even though the math shows that it always goes up. Okay. Let's go next slide, please, Molly. Okay, so we're going to end here. Why most people don't do this. And this addresses, why we don't do these things, the things that we're working against constantly. And that's because, like we said, we live in a world that isn't built for us or built for our brains to succeed in investing. It's in fact engineered to pull us right out of this idea of sophistication. So let's talk about number one, optimizing tactics. This is what people tend to do. So what's the right stock? What's the right ETF? When should I buy? When should I sell? Because it feels productive to be doing something. We want to optimize, but wealth isn't about optimization. It's about boring consistency. And we know this, but it's not sexy. And I'll give you a story from today. It's funny. In addition to my safe and boring portfolio, I like to, I teach some of our women how to trade options, or not trade options, buy and sell options in a very responsible way. So we do what's called covered calls and cash secured puts. But I do this and it's safe income. I also had this one, like I said, Nvidia option, and it's called a leap option. And I've had this. And again, I have a strategy behind it. When it goes up $500, I sell it and then I buy it low. And then it just makes this $500 for me at least twice a month. Okay, fine. I digress. But, yesterday it was up $600. My system that I put into place said when it hits 500, I sell. But I knew earnings are coming out tonight and I don't want to have regret aversion if this thing skyrockets to 1,000. So what did I do? I went against the system that I put in place for myself. I canceled my sell order. Remember, it was $600 I would have made, okay? Only on a $3,000 investment. And then I woke up this morning thinking, oh yeah, it's going to be up $1,000 and I'll sell then. No, it was actually down $200. Okay. I know this stuff and I am not immune. Okay. So again, that's just the idea of tactics, systems over tactics. This idea of copying others. Okay. So it feels safe. This is again, herd behavior. It feels safe to do what everyone else is doing. If everyone else isn't buying Nvidia, you don't want to be the only one not in it. If everyone else is panicking, you don't want to look like the stupid one staying invested. Right? When again, data shows that the stupid ones who stay invested are the ones that win in the long run. And why? Because we're social creatures. We want to do what everyone else is doing and we don't like standing alone. So we copy people. Okay. Another thing, we react to headlines. Okay. So again, news, Trump, all of this stuff, it's designed to activate us. It's by design. Threat sells, extremes sell, urgency sells. Again, remember this idea of salience. And whenever we feel urgency, what do? We make short-term decisions. Again, we talked about narrow bracketing versus wide bracketing. We want to be wide bracketers. But this rush, everything urgent. Oh my God, look at what happened. Narrow bracket, right? And then number 4, what did I write here? Understanding their own biases. So again, everyone thinks biases apply to other people. Overconfidence is one of the most persistent, biases in finance. I described it, that what I just did. I was confident. I thought earnings are going to come out. I was wrong. So wrong. We think that we'll be rational, and then you see your portfolio drop 30%, and then you're human again. There's a phrase in finance, and that's that you don't really understand your true risk tolerance until you've lived through a massive correction. And honestly, we haven't had one since 0809. COVID was just a blip. Like that has nothing to do with what it really feels like. Imagine for 10 years watching your portfolio go down and still having the wherewithal to stay invested. That's being a good investor. So all of this to say, everybody, the world is not structured to make you a sophisticated wealth builder. It is structured to trigger you. Okay. Which means if you want different outcomes, you can't rely on what? You can't rely on willpower. You have to rely on design. Again, make my NVIDIA Leap option your like lesson, right? I know how options work. I know it. Designed this perfect system for myself. And this happened yesterday. No, failed. Why? Because I canceled out the system that I built. And that's all she wrote, everybody. So that's what I have for you for today. Oh, and this is me in a sweatshirt. So again, I just say, yeah, behavioral finance, CFA designation. My specialty is behavioral finance and economics. And I've got here selfinvested.ca is our women's investment community. And we get together every week and we talk everything finance and mental health and well-being and how becoming a well-rounded woman essentially makes us well-rounded investors. And I do work with guys too.
She absolutely does. Thank you so much, Talia. I know,
Oh,
again, if this has been valuable for you, if you want to get in touch with Talia, please do reach out. I will send you her email and I'll also add it to the slides and everything when we upload as well. Talia, I just want to thank you first of all sharing that wealth of information and also just for being so transparent. I just think it's so refreshing that you give that example from yesterday of like you have
yeah,
the systems, you have the understanding, you've been doing this for like over a decade. And I'm just curious, like, how do you navigate that? You know, like when you say, like, I'm wrong, because I think
yeah,
that this is like, it's really helpful to kind of see how you navigate that for other people because it's easy for us, right, to go into that panic mode. And it's
yeah.
easier for us to be like, oh my God, like, I'm never going to do this again and all that stuff. So, how do you, at the level that you're at now, when you make those mistakes, when you make those wrong calls, how do you navigate it?
There's two things I say to myself. So, number one, broad bracketer versus narrow bracketer, right? I made a decision as a narrow bracketer. I'm going to do what I think is best for me right now because I want to make $1,000 and not 500. Narrow bracketing. Wide bracketer is understanding it in context with like all of the decisions. No, I understand how the market works. I've set systems to kind of, keep myself in check because human emotion, who am I to think I know better than the stock market? No, like nobody does. Nobel Prize laureates don't know what's going to go up and down. So who am I to think I know something? The other thing I like to think of is, for all of us, when we go to the gym, it hurts, right? Why do we go back? Because we know that the long game is that if we keep showing up, it gets easier. And if we keep showing up, that, we become healthy. So again, all of these things, like in our options group, for example, one of our girls, she wrote a call on Monday and she thought she wrote it and she actually didn't. And, she's working with really, really small amounts. Like this mistake, if you will, cost her $12 in concept. Like it was nothing. But the idea is that great, you learned it because you can teach something all you want, but when you actually experience it, it's very different. So I told her, you know what I mean? Like, fantastic. This one cost you $12. So when it's 100 times more, when it's a $1,200 decision, you have the experience to navigate through it. So again, what I did today with NVIDIA, again, I was like literally when I was washing my hair for this thing, I'm just like, okay, stick my buy order in, stick my sell order back in, and go back default to the system because I can't believe that I'm smarter than the market. And that decision I made yesterday implied that.
Mm. That makes so much sense. And it's so interesting that you even talk about like the people that you coach and you work with as well, because then that's the next layer, right? Because then you might be sharing something and then they take action on it and then they start freaking out. Like, oh, the
Yeah.
thing that I did and that didn't work. And then it's like navigating that. And I love how you said, like, well, that's learning. Like it's the
Right.
experience of having that.
Where do you learn the best financial decisions? It's not through your wins. In fact, you learn arrogance from your wins. It's from your losses. So, like, yes, we want to mitigate those losses. So, how do you mitigate those losses? You practice, and the other thing is shame. I see this a lot, and I'm in some of the groups and people will say, even yesterday, there was a woman, oh my God, they were asking about whole life insurance versus term insurance. And I just basically said, term insurance, it's supposed to be an investment product that's perfect. That's all you need. Whole life is this hybrid investment insurance product that is not good for most people, almost all people who have a net worth under 25 million. But essentially, it's not a great product. And a woman came in, I know this is horrible. I was, scammed into buying this whole life insurance product and I don't need. And I said, no, let's take the shame whole idea out of it. Right. Look, it's better than nothing. It's better than spending the money. And that's all okay. Right. Like, I'll often say, look, I study behavioral finance. I have a CFA and I bought a Hilton timeshare like 15 years ago. So cost me 40 grand at a time when I was just single mom studying economics and I had no money and they roped me into buying a timeshare and it cost me a lot of money. So again, am I going to shame myself for it or am I going to just say, it's part of the learning journey,
Mm, I love
right?
that. I love that. And I think a lot of what you shared today too is it requires quite a bit of self-awareness,
Yeah,
like how you operate, how you show up. Do you find that people who start working with you start having these like almost like awakenings to like, oh, this is what I'm like? Because it's almost like this self-discovery as well.
it is. It's this it I'll often say it's not about the money when I help you build a portfolio. It's about who you become in the process of building wealth. Suddenly I see like everybody wants to, make more money. Then they're like, oh my God, like I said, when we create a hole, nature wants to fill it. If you have, a stream, a river, and a rock is in the sand at the bottom of the river, and that rock suddenly moves, does the water skip over it? No. Nature has a tendency to fill things, right? That have an open vacuum, right? Like I said, you start the investment account. Suddenly they didn't know it existed and they started this investment account. Now their whole journey is how do I fill this investment account? That's the change that we need to create. I could tell you in 10 seconds, and I'll tell you right now I got to over $200,000 with three ETFs: VCE, which is Canada, VOO, which is the States, and VEU, which is the world. Those three took me over to 200 grand. From there, then I started adding what we call satellite portfolios. But if that's all you do for the rest of your life, you are going to be set. You are going to do better than all of these people who have been studying finance and thought that they could, outsmart you. So it's not hard. That's why I became obsessed with this idea of if it's so easy, why aren't we doing it? Enter behavioral finance, right? All of the stuff we talked about. We have things going against us. Again, we are always being nudged to make decisions that are not in our best interest. And when we can see these, everything from like prepaying cruises because it doesn't feel like a loss. They found people buy wine as an investment and they don't feel bad about it. But then they consume it and it's just like, oh, okay, I just blew 3 grand. Like it's not like people just don't feel the losses. So there's like I said, we just talked about a few of these things, but there are hundreds always shaping the way we make decisions. So again, don't feel bad if you're not where you are, where you want to be financially. It's just a matter of, okay, how do I adjust, orient, and then, act on those systems and,
Mm,
and, and, what's the word? Apply them.
yeah, I love that you spoke to that too, because I think that that is so real, that feeling of like it's for those people over there that know what they're doing, and
Yes.
I don't know what I'm doing, and I'm scared of getting it wrong. And then it's all those things, right? And like you say, when you actually do it, I started investing for the first time last year, and I'm like, oh, it's kind of just like moving from like one account to another. Like I'm just making a transfer. But
It's
like it
literally that easy.
felt so massive. Like it took years to get to that point where I'm like, oh, I am that person. I remember you said this on the last call to be like, oh, now I'm an invest like my identity's changing, which is massive.
And what happens when your identity changes? You see a podcast and you're like, oh, that's for me now. You see a new book comes out. That's for me. And then everything starts shifting. And it's funny, I can't tell you the amount of tears that I have seen when, like, again, we've been traumatized by money. This was the previous call for those of you who didn't attend. A lot of us have experienced either financial scarcity. We have experienced, like, one of our ladies, for example, and she shares this openly, so she wouldn't mind me sharing it too. She had a situation where her father worked for a company that embezzled money. And then his boss later on murdered his family, and killed himself. And that's what she grew up in. This was the markets to her. Murder, suicide. And then she wonders why she's afraid to participate in the markets. So this stuff runs really, really, really deep. A lot of it is, even generational, right? Our grandparents, when we were young, we don't realize, but the commentary at home, it's for them versus us. It's them versus us. Rich people are evil, all of this. We have these are the lenses through which we're making our financial decisions. So there's all kinds of subconscious things going on. And when we become aware of them, it's like we can't unsee them. And then we can, like I said, build systems or build new identities that honor where we've come from in a way that's tender and has no shame attached, while still, growing and moving forward and building something great. And look, it's fantastic. I love, and I think I said this last time, the Tony Robbins quote. He says, for those of you who think that money doesn't buy happiness, you haven't given enough of it away.
That is so good. I loved it when you
Great,
said that.
right?
Yeah, so good.
And that negates all of the conditioning that we've heard that rich people are bad. No, if you're a good person and you have a lot of money, you can do a lot of good with that money. So better to do that good than not, right? So again, these are just again all the things that we work on, and I challenge and I poke a little bit, and yeah, it's kind of fun.
I love it
Not
so
because I'm
much.
good at it, but because I've been working on it for myself for
Because
20
you've
years.
learned, you've had experience, right? You've gone through it.
Oh my God, I'm the worst. I'm literally the worst. So I can see it. I can see it so clearly.
I
Yeah.
love it. I could keep asking questions, but I'm going to open it up to the floor. I'm going to share my screen so that we can
Oh my
start
God. Okay.
answering some of these questions. So, first question, based on your last call, it seems that my issues aren't with systems, but with under earning or not consistently earning enough money. How can I address this?
Call me. So asking a question like this is like asking, why can't I lose weight? Right? Like it could be anything, it could be like, why can't you lose weight? Because it's, genetic, because you have something, going on, because your habits are bad. So this is a similar question, but let's talk about it in a way that I feel everyone can get something out of. And then to the poster, again, feel free to contact me and we can work through your specific situation. This idea of, us saying like, we just need to earn more, I think it's a bit of a catch-all. And I don't want to use the word cop out because that has a negative connotation, but I'm going to say cop out a little bit. And I'll give you an example. Last month, I was teaching healing professionals, so I think massage therapists and lymphatic drainage specialists, and we were talking about how to earn more. So for them, the issue is identity. Just think about this. When we're compensated financially, our nervous systems feel like we're somehow taking away from helping the other person. So what do? We chronically undercharge them, and then we burn out, and then we get angry at them because there wasn't a fair value exchange. And then we end up hating our clients, right? Rinse, lather, repeat. So that's something. And actually, I have those seminars taped. So if anyone who's interested, again, reach out to me and I'll send those to you. No problem. We talked about all kinds of different things. Last call, we talked about this idea of the identity ceiling. Think about the people around you. Are the people around you high earners? Or are you always listening to people talk about how hard it is, how the economy sucks, right? We talked about this idea that winter, there is such thing as a financial winter. We're in one. Well, some people learn to ski in the winter and some people freeze, right? So which one are you? If you're around skiers, better chance that you're going to learn to freeze. So think about this. Are you someone who says things like, I just want to be able to pay my bills? Or do you have beliefs that if you work more, you're not going to have time for your family? That's super common. I work with a lot of single moms, and this is a big one, right? I just don't have the time right now. Okay, well, if you believe that you don't have the time, you're not going to do the things to realize that you actually don't need all the time in the world to make money. Another thing too, like I said, you may have had money taken from you at some point in your life. I think I mentioned last call, one of our ladies, when she first started earning money, she was making like minimum wage, and her father lovingly said, women don't know how to spend money, so I will be spending your money and deciding how the family spends it. And he did it out of love. But what she heard, what's the point? So what happened with her? She became a chronic under earner, because what's the point? It will always be taken away from me. So again, this idea that, it's such a broad question. I tried to sort of sprinkle a lot of different ideas at you. Again, like I said, call me. We can work it out with you, what's going on. But I would say for everybody, figure out where the problem is. So for example, are you avoiding something? Are you not asking for a raise? That could be a problem. Do you avoid being seen? Do you think that by me being a, earner, I have to get in front of people and talk to people and my nervous system can't do this, so it's just not worth it. Like it could be anything. Once you figure out what the problem is, instead of asking, how do I earn more? You want to ask, what does someone who makes 5 times what I do daily? And then start doing those things. Honestly, like I ask myself all the time, because again, like I said, I'm not immune to this. Is there somebody in this world who has less education than I do, who, works less than I do, but who makes 100 times more than I do? And the answer is probably yes. So I want to find those people, find what they're doing that I'm not, and then do those things. And then the last thing I've got for chronic under earning, and again, like it was there. I still struggle with this. Set a rejection quota for yourself. And this has helped so many of the people. And I see Kareen here. Kareen, you know this, that this is something I believe in. A lot of why we under earn is because we're afraid of asking for things. A lot of us have been told that polite women don't ask. It's rude, right? And if you set yourself a rejection quota, the idea is you have to collect no's. So you ask for things. And, when you get the no, you're like, okay, cool, tick, got one. So what it does is it makes you immune to hearing no, which is why we don't ask, which is why we don't earn for a lot of the time. So again, that's kind of my very broad trying to get all kinds of different angles at you.
That's really
Hope,
helpful. It's kind of like
hope
turning it
something
into a
did help.
game.
You have to game the system, right? Because if you're like, I'm going to collect a no, okay. And one thing I think, I'm not sure if I mentioned it on the last call, that I love to do is when after you have a meal, and you know how they ask you if you want like a cappuccino after your meal, and they give you that biscotti, that little cookie
Mhm.
next to your coffee. And I love that. Like I love dipping a biscotti. This is like one of my pleasures in life. I will always ask for a second because I love it. And
Mm.
I asked the server, can I have another one? It was really good. And in fact, who gets the more joy? Me or the server? The server, because they're like, oh my God, now a free opportunity for me to get a bigger tip. She loves it. I can do it for free. It looks like I did it. Right. So always ask. Never be afraid to ask. Again, my 2 cents.
I love that. And it's kind of like that exposure, isn't it? Like you say, in those like daily interactions, that
Yeah.
it's not necessarily high stakes
Yeah.
because you'll probably never see this person again. It's not going to impact like your work or your career. You don't have to go back there. It's tiny, but it tells your nervous system that actually like it's safe to do that.
And it's funny. Like I can just imagine sitting in a restaurant. Can I have a second one of these biscottis? No. Okay.
Not
Like
coming
it's
here
just
again.
no, like it's just kind of funny, right? So again, do it in these small stakes situations, and then you become someone who asks, and someone who asks will earn more.
I love that. Please could you share a list, preferably ranked, of your top 5 favorite books on behavioral finance?
Yeah, just getting me out of like live there. My favorite one is Richard Thaler's Nudge. It's amazing. A lot of the things I talked about today is probably in Nudge. Again, nudging being this idea that we are always being gently pushed. In his book after that, and I don't remember what it's called, forgive me, he talks about the sludge factor, which is why it's so hard to cancel subscriptions, except mine. I make mine very easy for that reason. Another famous one is Thinking Fast and Slow by Dan Kahneman, one of my very, very favorites. It's a big, thick book. You probably would have seen it. It came out years ago. It was like bestseller, still is on the bestseller list, and it's got a picture of a pencil on it. Dan Ariely is great. Predictably Irrational, that I mentioned, was one of his books. Money and Sense. His is a little lighter. Dan Kahneman tends to write pretty, a little heavier. And then anything by my favorite economist, Robert Shiller. So Shiller's famous book is called Irrational Exuberance. And honestly, the reason I got into the markets was because of Shiller before I could afford to go back to school and study finance at the University of Toronto. I watched his course on Open Yale, and it's a free course that you can audit on Coursera too, and it's called Financial Markets by Robert Shiller. So again, if you kind of want someone to inspire you a little bit, I highly recommend that. I love him, all of his books, Animal Spirits, Irrational Exuberance, Narrative Economics, brilliant. But start with Thaler. Thaler and Dan Ariely, they tend to be lighter. So Nudge, start with Nudge.
Perfect. This person is saying, I hope you plan to write a book on behavioral finance, sharing your personal take and experiences. I very much look forward to this. Is that in the pipeline, Talia?
Oh yeah. Oh yeah. I do. Well, our group is called Self-Invested because my idea is that we need to be able to invest for ourselves, by ourselves, in ourselves. And when we have this, like we say, this like investor identity, everything changes. And it's not like overnight. it's small 1% shifts that you just realize, like, I'm a different person. I'll often use a friend of mine as an example who didn't know even how to open a registered account a year and a half ago. And now she is her family's financial advisor, and she's asking me how to structure hedge fund like fees for, for her family. And it's like, we look at it and it's just like, this is the change that I'm trying to create. I want women, mostly in my group, but again, like I said, I do work with men also, but I want us to feel like finance is for us. And when we feel, and some, here's a simple way that I always guide people is there's a lot of fear in doing our first investment. We just feel like we don't know what we're doing or what button to press or market order versus limit order. And it's overwhelming, right? And I'll often come on the phone with people and just hold their hand, do it with them. And there's always that moment when they do it where they're like, it was that easy, 5 seconds, and I did it. And I'll say, well, hold on a second. What did you just do? And they're like, I don't really know. I just bought a stock. Okay. When you buy an ETF, VOO, let's just say, very common, S&P 500, you have just bought the right to participate in the gain of 505 different companies that hundreds and thousands of founders and employees and CEOs give their blood, sweat, and tears to build. And in 10 seconds, you got the right to participate in that. When you can understand the gravitas, do you know what I mean? And how elegant the markets are, and how that you behind the robo advisor being the next one, you know what I mean? Like, you just sort of can press a button and get that right. Like, that's pretty cool. And when you understand how cool it is, it gets you excited to do it. And it's not this black box, dangerous, black and gold screens and like bulls, and it's not. It can be a regulating, safe, beautiful experience. And that's kind of how I approach this.
Yeah, I
And more.
feel that so much. Like when you talk, I'm like, I feel like goosebumps and I feel like super excited. And it's so different, right? Because like you
Yeah.
say, there's so much fear around it, but I'm like, oh, like I do have the right to invest. And like, wow, that's incredible. Like being able to do that. Like, and again, it's the identity thing, isn't it?
Yeah. Yeah. I love that you say that's beautiful, actually. I do have
Mhm.
the right to invest. I think like you hit on something really profound. One of the things I hear most is like I said, I can't invest because I have no money. Honestly, do you have $5? Like, again, that's all I'm concerned about. I'm not concerned about the amount. I'm concerned about the reps. So, if you have $5 to put in your investment account, and if you don't, there are other things that you need to work on. But, put $5 in that investment account, then see $10 the next week, and then see 15, but you don't see 15, you'll see 17. And then you're like, oh, I kind of like this. And then, you know what I mean? And when you kind of like it, you're like, okay, I can do $10 and then I can do 50. And that's how it starts, right? It starts from the identity level, not the like, I have to have so much money and, you know, yeah,
Mm.
my 2 cents.
Yeah, no, I love it. I love how you bring that enthusiasm and excitement because it's just like infectious, it like really rubs off. And I think that's why this community especially just love you because
Thank you.
it's that infectious, new, fresh, energizing approach to all of this that has seemed scary, and
Thank you.
so
It's
yeah, I
not
really
scary. And
appreciate that about you.
and for anyone who feels it's scary, again, call Molly, call me. We can make it super easy. It doesn't have to be scary. And I guarantee that like when you start, you're going to be like, again, like I said, I see tears all the time. They're like, oh my God, it's been literally 3 years of anxiety for this. And
Mm.
I'm like, yeah, yeah. See, it's not that bad. And then they love it. And then they change their life.
Hmm.
Okay, next one,
Okay, so do you
robo-advisors.
recommend robo-advisors?
Yeah, 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 they're great. Like just by, choosing. So for example, I'm going to use Wealthsimple for the Canadians, or Vanguard in the States. They have these predetermined portfolios. They're great. And they do it for you. One thing you just want to look at is fees. I don't think you need to have these predetermined portfolios. If it's the difference of you doing it and not, then they're great. But honestly, like go to Vanguard if you're in the States, go to Wealthsimple if you're in Canada. There's other ones. Vanguard is international. So again, whatever country you're in, I can tell you the best one. Um, Buy VOO, buy VCE, buy VEU. And what that is again, a beautiful, diversified global portfolio, assuming that you're okay with all equities and all stocks. But you've got Canada, the US, and the world. And again, if you do nothing else, you can just set it and forget it. You know what I mean? I've got a challenge I put in our Facebook group is I wanted everyone to save $10 a day for 100 days for those that couldn't believe they couldn't believe that they were investors. And I said, honestly, like just do something, save 10 bucks. And then at the end of 100 days, you'll have $1,000 and I will help you build a money machine with that $1,000. I will help you put it into your accounts and see it grow. So again, we can do it on our own. I don't believe in going to banks and getting high cost mutual funds. That's what I don't believe in. So if you go to one of these cheap platforms, yeah, definitely get one of their predetermined portfolios, or just buy your own little global diversified portfolio. And again, if you want ideas as to what to buy, again, just let me know and I'm happy to have that conversation.
Yeah, that's super helpful. You just talked about stocks there. What's your like standpoint on bonds? And like, is that something that you talk about with your audience?
Yes, yes. The world has changed. You know, we used to have what was called the 60-40, which is 60% equities or stocks, and then 40% fixed income or bonds. This was based on Robert Merton. He won the Nobel Prize on this. And he basically has this model that our goal is to smooth income over time and that we just like, you know, regular people, we don't earn because we're going to school, we have mortgages, so we owe. Then we go into our accumulation year, so we accumulate all this money so that when we're 65, we can have money that we can live on for the rest of our life. Okay, this isn't life, right? I'll tell our ladies this all the time. Life goes up, life goes down. Think about the life of a woman. You know what I mean? And there are guys, I know we're speaking to a heavily male audience today, and this applies to guys too. But women are the primary caregivers. They lose years on, raising families. They lose out on raises. They live longer. So it's really important for us to understand that our portfolio needs to reflect where we are in life. Why I say that. If you think of a lever or a spectrum, okay, one side is safety, one side is growth. You know, the markets are set up that you can't have a super safe investment that's going to grow really, really quickly, right? We talked about this idea of the equity risk premium. The more risk you take, the more you need to be compensated for in terms of return. So you always want to feel like you're able to adjust this lever. If you want capital growth, which is growing, at an accelerated rate, you want 100% equities. If you want capital preservation, which is preserving what you've built, you want 100% bonds. And I'm going to say bonds are bond-like products. There are products that aren't bonds that behave like bonds. Okay. So that's what you're always toggling between is how much do I want my capital to grow versus how much do I want it to preserve itself. Well, again, if you have a 30-year time horizon and you want to grow 10,000 to like 2.5 million, I don't recommend a bond allocation. If you are 65 and you have, or 75 and you have accumulated, a good amount of wealth and you need that money to live the rest of, next 20 years of your life, then yes, I recommend a lot of bonds. So again, it's understanding what your asset allocation is and what's appropriate for you given your goal. And again, I know I mentioned target date funds. What's cool about a target date fund is like if you're 30, it's 100% equities. And then as you age, it changes that for you. So you don't even have to worry about it. But again, it's a conversation and it's a lesson that I could teach you in 20 minutes. So, bonds are fine. Do I have any bonds currently? No. I'm 43, but I also have a higher tolerance to risk.
Okay, that's really, really helpful. That's really good to know. Thank you. And it kind of leads us on to this question here.
Yeah.
So I'm assuming this person's not invested yet. So what's my first step to start investing?
Okay, open the accounts first. So if you're in the States, you want to open up a Roth IRA or an IRA, traditional IRA. Actually, before you even do that, if you have an employer that matches your retirement accounts, so in the States, you would call it a 401k, and in Canada, we have RRSPs. So if your employer is offering a match, the first thing you want to do is say yes to that match and you want to max it out. That is typically, if they're matching 100%, that's 100% gain. So you don't want to leave any of that money on the table. You want to take it all. After that, open up your registered accounts. Like I said, in the States, you've got an IRA or a Roth IRA. In Canada, you've got a TFSA or a tax-free savings account and an RRSP, registered retirement savings plan. So once you have these two accounts open, they're open. They're like, bring it on. Money has to start coming in. At that point, like I said, build a system, today's talk, about automatic contributions so that you don't see it go in. Remember, when you can see it, that's when you can like start mucking it up. Set an automatic contribution. People like to use the 10% sort of goal. I understand. I don't like rules of thumb for finance. It's very individual. What I do with, our community, I'll often say, can we do 10%? and understand that if it's a lot at first, then the next month they do 5%. Like it's not a big deal. We can start with 2% and then we can lift it up, right? So just become someone who automatically contributes. Once that money is in the purse, if you will, so those vehicles, again, being the IRAs or the RSP TFSA combination, once the money is in there, you have to do stuff with that money. That's when you buy securities. And when you're beginning, I would highly recommend you buying the securities that I mentioned, which are what we call asset allocation ETFs, exchange traded funds. There are many. In Canada, the EQTs, and actually you have them in the States too. So we have VEQT, ZEQT, XEQT. These are good. This is like an all-in-one. Find out what are popular asset allocation ETFs. Choose one. What you don't want to start doing is buying individual stocks. You want to have a basket full so that, for example, when Nvidia goes down, you're not wiped out, right? Don't invest in crypto, right? I mean, I preface that. Crypto is a totally fine investment if it's a small part of your portfolio and you understand that it's a very risky investment. Again, not where you want to start. So again, open the accounts, money's going to come in. With that money that comes in, you buy ETFs or exchange traded funds. It's a simple Google search. And that's it. Do it forever is the third law. Don't stop ever.
Amazing. So helpful, thank you. So, in addition to books, are there any other resources on this important topic that you would recommend?
Yeah. I mean, look, there's Robert Schiller. There's, like I said, Open Yale. Study this stuff. It's fun. Behavioral economics is great. If you hated economics in school, this is a totally different animal because it allows you to see where you're screwed up. That's why I study it. It's so much fun. But yeah, like in terms of other resources, I mean, yeah, online courses would be great. Again, call me. I'm happy to guide you and be your Sherpa on this too. So, like I said, we do calls every week. Not all on behavioral economics or finance, but it's who I am and it's how I approach wealth building. So, for example, I will never say to someone, our job right now is to build you the perfect portfolio. Right? I don't know what the perfect portfolio is. Look, if crypto does really, really well, then one might argue that the perfect portfolio is 100% crypto. But we can't look, we're not forward. Like we don't know what's going to happen. So, my goal when I work with people is what am I trying to get you to do? I'm trying to get you to do slow, boring, unsexy things over a long period of time. And what's the best way to do that? Well, for me, I would say I would get you to love the process, right? Which is again why I talk about this. Like it's passionate, like I love it. And then I would, have you recognize your own identity as an investor so that this is something that you do because it's who you are. You would never say to someone, who's not a smoker, would you say to them like, oh, what's your favorite cigarette brand? Like there's no answer. They're just like, no, I'm not a smoker. So for example, I want you to have the identity of I'm an investor. So it's just what you do. So yeah, again, you can reach out to me, happy to guide you, or find someone that you really gel with too, right? But again, what I don't recommend is you going to a bank and getting a high cost mutual fund. I always say that, the bank, the advisors don't work for you. They're like, oh, but it's free. I'm like, yeah, because they work for the bank and they're making a lot of money on you. So
Mm.
again, I kind of took that in all kinds of different directions.
No, I think that was really helpful, and I really liked actually that you used that like cigarette analogy because it's like it's so true that kind of like each of us are so individual and unique. So to have like a blanket one size fits all approach actually seems really silly. Like now that
Yeah.
we're thinking about this because we do have such different stories, we come from different places, different beliefs, all that identity stuff, and then what we have to work with as well. It's we're all very individual.
We're individual and we're beautifully flawed. And
Mm.
here's just an example. I have my own financial trauma, and I will often say that I don't like, for example, an emergency fund. I don't have one. Again, I will never call it that. I'll call it an opportunities fund. Why do I not have an opportunities fund? Well, because I have a healthy investment portfolio. And the idea of having $25,000 sitting in a money market fund, not making any money, makes me very uneasy. I think it's dead money. Is this right? No. Like, is that something I would ever advise someone? Should I not? Oh, should I have all my money working for me? No, like I would never. This is my own issue. And I'll tell you why I'm this way so that you can then create a, you know what I mean, like a strategy for yourself. I'm the kind of person who thinks that if I want to buy a house, I will put that money in the market. And if the market tends to go, like, will go down next year, if it does, what I mean by that, if it does, I just won't buy a house that year. Like, I'm the kind of person that's like, oh, okay, I'll wait 4 years or I'll wait 5 years. But I don't want money sitting doing nothing. And I see this, I think it comes from working with a lot of single moms. And when I work with single moms, they all talk about because, and rightfully so, you know, you hear the Ramit Sethi and all of this, build your war chest and build your emergency fund because if you're out of work, the last thing you want to do is take on debt. And I don't disagree with him. I think it's very prudent and I think it's good advice. What I am countering it with is this idea that, look, if you're not a high earner right now, and again, a lot of single moms are raising kids, they just gave birth, they're maybe not working full time, their bills are much higher. If they have this view that they just have to build a 6 month war chest, that might take them 5 years. And in that 5 years, none of their money has been put to work. And they hate it. So, you know, I'll often say, yeah, let's start building that emergency fund. But at the same time, let's put 10 bucks into the market so that you build your investing muscle. And that, like I said, if there's a space, you're going to want to fill it. And you're going to usually want to fill that by wanting to earn more. So again, it's not a right or wrong answer. It's not, I'll often say it's not a button pressing exercise. It's a lever pulling exercise, right? There's always trade-offs. In economics, we call it opportunity cost, right? So understand who you are as an investor, how to build systems to counteract things that you don't want yourself to do, and how to make things that you don't want to do hard.
Yeah, that's a great example as well. Really great. And I know that people are wanting to reach out to you. How do they get the recordings? I saw that somebody in the chat also wants to bring you on as a speaker for something
Oh my
else.
God,
So
thank you. I would love to.
so can you maybe drop your email in the chat as well? I will add this to the recording and everything. But I assume that's going to be the quickest and most direct way. If you have questions for Talia, if you want to set up a call with Talia, if you want to invite her onto something, if you have more questions that you want, then I will add it to the slide as well. But also, Talia is dropping all the links in the
All of my
chat.
information. And, you know, again, I also have a Facebook group called Self Invested. The Facebook group is for women because I try to create a safe space for women, again, many of whom are going through financial trauma caused by divorce. So I try to keep it a very feminine place. But for guys, again, reach out to me. One of the things I'm doing with my more sophisticated investors is I am teaching them how to use options in a way that is not Wild West. So you may have heard that options, like my NVIDIA one, options are very speculative, very dangerous. And to say options are dangerous is like to say the markets are dangerous. So there are a lot of option strategies that are exceptionally dangerous and that nobody, in my opinion, should ever do. There are also option strategies that are very safe. In fact, they are safer than actually owning the stock upright. Things like covered calls or cash secured puts. That's what I teach. So if anyone wants to learn how to use options in a way that's very, I mean, there is risk. The risk is that to make money on options, you do have to own some individual stocks. So, you know, we talk about, you know, finding good quality companies that, you know, will make money in the long run and using those to write your options. But that's something else if you're interested in, and this includes the guys too, let me know. And I'm happy to teach you how to use options responsibly to generate income for the rest of your life. But beyond that, honestly, like, don't buy individual stocks, all
Mm.
ETFs, all baskets, make it default, you know, and that's, again, the option strategy is something that I think, especially for women, it's a great skill to have in retirement where you can make income.
Yeah, absolutely. Wow. Talia, you are such a wealth of knowledge. As you can see, she's got so much to offer, so much value here. And I've seen in the chat that people are like, thank you for making it so simple and practical. And I think that it's funny because it was kind of a conversation you and I were having prior to this conversation, how it's so easy to use all these like really complex languages and to overcomplicate things. And I think you do such a fantastic job of actually just breaking it down and making it so digestible, and really giving that education in a way that it's like, oh, that's not too scary. Like I can do this.
Yes. And I try to frame things in a way that's still, look, I'm talking to a group here of sophisticated people. Do you know what I mean? So I can use things like loss aversion, risk aversion, you know, narrow bracketing, wide bracketing, and then explain what it is in real English. So that you then feel like you can contribute to a conversation intelligently. It was actually one beautiful thing. One of the greatest compliments I ever got was from a girl who, one of our members, she emailed me and she's like, I have to tell you something. She goes, I went on a date and he was a banker. And she goes, I understood everything he was talking about. And we were talking about investment strategies. And she goes, a year ago, that would have flown so far over my head, but she has the language now. You know what I mean? And like you say, the most sophisticated, intelligent people, I think, are the people. And I try to be able to communicate things simply, but still intelligently,
Yeah,
because I
you
am
do.
a good grammar.
But you do such a fantastic job, and I was definitely jotting down as I was like cognitive discounting, and I'm like, oh, and mental accounting and sludge and decoy effect, and I'm writing all these words down, and I'm like, it feels good on the brain, just to
Yeah,
have
doesn't
like
it? The
the
decoy.
actual word for it, and you're like, ooh, now when I go into a restaurant, I'm like, oh, that's the
That's
decoy
the decoy.
effect. You
So
see?
like next time you go see a movie and you see small popcorn, $3, medium popcorn, 6.50, large, 7, which one's the decoy? 6.50. Because they
Mm.
want you to buy the one that's just 50 cents more and they're making a lot more money on it. So the decoy is anything you see on a menu where they're trying to nudge you to make a more expensive decision. So now you'll see this. That's a decoy. That's a decoy. You know what I mean? Behavioral economics, when you go to Starbucks and you see the calorie count next to the item, they're trying to nudge you to make a healthier choice. That's a nudge. Thaler talks about that in his book. So yeah, you'll love it. I get so excited.
It's so like empowering though, right? Because you make a decision based off like I know what you're doing
Yeah.
and I'm gonna make this decision instead of just like, oh my God, I just spent all this money or I ate this thing or it's like, oh no, like I know that you were trying to do that and it's
Yeah,
actually then so much more empowering in a way.
it is. It is. And yeah, it's just fun. I like it.
Amazing. Thank you so much, Talia. I'm seeing in the chat, truly you have the gift of great communication, and I completely agree.
Thank you.
There's been so much value in this call. Like I said, if you haven't watched the call from 2 weeks ago, I highly recommend going and watching that one as well. This will be uploaded within the next 24 hours. Recommend going back, watching it through. There was so much. I will definitely be going back through and making more notes again. But Talia, thank you so much. Do you have any final words before we close?
Oh my God. I just honestly, I hope that I have said something between this session and last session that has made your life 1% better. If you make one decision today, like automating $50 a week into your investment accounts or buying your first ETF, that could be the difference between having hundreds of thousands of dollars in retirement and not. And if I could contribute in any way to that decision that you've made because of today's presentation, that's why I'm here. That's my reason for being. So again, anybody that needs more support, I'm very generous with my time. I love talking about this stuff. So reach out to me anytime.
So beautiful. And yeah, you can see how passionate Talia is, and she genuinely does want to help. So, like I said, I'll be posting all the links. Please do reach out to Talia, get on a call with her. She is fantastic at everything she does. And we're so grateful that you've been able to share your time, your expertise with us on these calls. Hopefully, we will be able to get you back again inside the community. I know everyone would love
Anytime.
that. And
Anytime.
yeah, please do, once the Zoom closes, everyone, please do leave your feedback in the survey. It's always great to hear how this session landed for you so that I can pass this on to Talia and the rest of the team as well. Talia, thank you so much.
Thank you. Thank you, everybody. Such a pleasure always to be here with you. And I've met some amazing people from this group. So anytime, I'm yours, always.
Amazing. Take care, everyone. Have a lovely rest of your week. Bye
Bye,
bye.
guys.